Hi there, folks, and welcome back to The Rules of Investing. It's our first episode for 2025. I hope you all had a great summer break. My name's James Marley. I'm a co-founder at Livewire. I'm going to be your host today. If you've not been following markets, it's fair to say the past few weeks have been anything but dull, with headlines dominated by news out of the White House and a new entrant in the AI arms race. Today, I'm joined by Luke Laretive, CEO and investment advisor at Melbourne-based Seneca Financial Solutions. Seneca provides wealth and portfolio management services. The firm also recently marked the one-year anniversary of its small cap fund. Today, we'll be bringing you up to speed on a few of the big themes setting the tone for 2025 and ask Luke about some of the opportunities that he's seeing. Now, if you did switch off over the break and you're just firing up your screens, you're in for a pleasant surprise. January 2025 is on track to deliver bumper returns, continuing the strong momentum of 2024. Gold, banks and small caps have been running hot. Even some of the laggard sectors such as materials and energy have joined the party. So the question is, are we seeing a healthy broadening of the rally we witnessed, or is FOMO and euphoria starting to dominate sentiment? Another big move has been the Aussie dollar, which has fallen from a high of 69 cents against the US dollar in September to a recent low of 61 cents and sits around the 63 mark at the time of recording. We're going to be diving into some of these topics today and ask Luke what they mean for investors. Now, if you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so you don't miss an episode. Or if you're a Livewire subscriber, hit the follow button at the bottom of the wire to be notified when new episodes are available. And if you're not a Livewire subscriber yet, just head on over to livewiremarkets.com. It's free, easy to register, and you'll get access to insights from some of the leading investment minds in the country. Now, Luke, with that intro done, welcome. It's been far from a dull start to the year. As I mentioned in the intro, January looking to lock in some impressive gains. If you were to identify two or three of the most important driving forces behind this rally, what would they be?
So we're up almost 3% in January so far. But January is a pretty good seasonal performer. Historically, we look back, I think it's the third or fourth best performing month of the year seasonally. So it's pretty good, has averaged sort of 1% returns over the long run. Been the banks, been the big story so far in January, been driving returns. I think Macquarie's sort of got some good comps coming out of the US in terms of some of the peer investment banks over there reporting really well. Non-bank financials playing a bit of a catch-up trade to the big four. But, over the last 12 months, we have seen bank valuations blow out 20 or 25%.
Yeah.
So
it was one of the big stories last year.
The big story of last year, in my view, particularly if you're talking about what's driving the index. I mean, that's what's driving the index. Can't ignore gold, which you mentioned in the headline. Newmont's up 2.4%, which is the big one in the benchmark at the moment. It's 2.4% of the benchmark, and it's up 12% in January. The gold stocks are moving as this sort of, as you mentioned, the Trump sort of inflationary policies in the US are starting to drive bond yields higher, which typically is pretty good for gold. So they're the sort of the main drivers, I think. Some of the other interest in inflation-sensitive sectors are also performing pretty well.
Okay. Now, my colleague Tom Richardson recently wrote a cracking article which covered the views of legendary investor Paul Tudor Jones, and he outlined 9 asset classes he believes will perform best in a post-pandemic era. Now, this is, a time where money printing has been rife, momentum has been gathering hold, and his view, Tudor Jones says, you should be following price action as a guide rather than being wedded to fundamentals, which probably sends shivers down your spine as a fundamental investor.
Not really.
For listeners, we'll put the link in the show notes, but it does pose a bit of a challenge to traditional views on investing. So what's your take on a view like that where you should just follow the money?
Yeah, I think for me, James, there's lots of ways to make money out of markets, right? There's lots of styles of investing. There's lots of things that work for different characters in the market. And, Tudor Jones has been a long-term momentum trader. That's his style. And I think certainly it's an interesting way to play the markets. He's been pretty successful at it over the longer run. And there are others who do really well out of these momentum-based strategies. I don't know whether the average $2 or $3 million SMSF in Australia can learn a lot from sort of Paul's strategy. I think it's probably not that executable or implementable for sort of the average person. And I think it's all very well and good to kind of highlight macro themes and the kind of drivers of the thinking behind what he's doing, but that's not actually what they're doing at a fund level. That's going to be, if you've got a view on bond yields, you've got a view on currency, you've got a view on whatever, that's going to be a hedge position. It's probably going to be some sort of structured product. It's going to be some sort of derivative or leveraged position. It's not just they're out there just buying tips. So I think it's a interesting to think about and chat about. Kind of makes you feel like you should be doing all this other stuff, but in reality, what works for people repeatably, sensibly, in my experience, is kind of pretty boring and the same. And while you can have these things as interesting conversation points, they're not actually that relevant.
Yeah. Well, I guess it brings me to our next point, which is, for investors that are looking at markets and doing the 2024 reviews, what was the best performing asset class, conversations around should you own Bitcoin. We were talking earlier about the Trump meme coin and, how did that happen? But it also seemed so obvious. And I imagine a lot of investors are even looking at something like CBA and saying, should they be allocating capital to these really momentum driven and strong performing assets, and how should they be thinking about it?
Yeah, I think when you're talking about asset allocation as a family, as an individual investor, as someone who's managing the wealth of your household, you've got to first start from a point of like, what is my reference portfolio? If all of this noise that we talk about, all this news, all of the things, it all just disappeared and we're in a vacuum, what's our asset allocation actually look like? How much do we have exposure to defensive and growth assets? And under that, how much have we got in each of the sort of major asset classes at a neutral sort of setting? From there, you can start to maybe think about, okay, we can tilt this based on a view or tilt that based on a view. But ideally, you'd want to know what those tilts are, how much tolerance you are willing to take on a punt or on a view. So from my perspective, I think it's all well and good to say, I'm going to swing my portfolio this way, but you end up just getting whipsawed around, particularly, okay, if you've got 50 grand, well, maybe not. But if you're talking about substantial amounts of money, which is the kind of people that we help at Seneca, so you can't really be doing that. It's more nuanced. It's more just tilting things. I think for us, we think non-US equities at the moment is a big opportunity relative to the US. I think emerging market equities are, median valuation at the moment, and US equities are standard deviations above median. So I think there's clearly an opportunity there. We think smalls over large broadly across the world. In fixed income also, non-US focused fixed income, particularly government and semi-government, we see some opportunities there, some really good yields on offer, and pretty compelling opportunities. So while Tudor Jones is going to continue to trade that sort of absolute return global macro type strategy, I think his particular style maybe isn't sort of how you should be allocating capital in your super or your family trust.
Yeah. Well, as we talked about, January, up 3% for the month. You do that over 12 months and you have a cracking year in markets. And this is off the back of two strong years where we've seen the S&P do 20% plus returns in 23 and 24. So do you think we're starting to see FOMO take hold of markets, or is what we're seeing a healthy broadening out of the rally into other parts of the market?
Yeah, I don't really think about it as, up or down in aggregate. I suppose it's more about like money flows and rotations and how money moves around the markets rather than sort of through them.
Yep.
I think it's always important to sort of have some level of specificity when we talk about markets and we talk about FOMO. Well, which stock are we talking about? Which market are we talking about? Like I said, the US is a completely different story to what's happening in China, and that's different to India, and that's different to the ASX, and it's different from ASX smalls to ASX large. So I think having some level of specificity, not getting caught up in broad-based narratives, like we were talking about before, that's kind of how we think about the markets is we want to sort of be, what's the broad-based narrative, and is that actually supported by data? And yeah, for me at the moment, I don't have any issues investing in this market. I think there's heaps of opportunities out there, whether that's the more value end, whether that's, good quality growth companies that maybe their growth's underappreciated. I think there's plenty of opportunity out there for investors at the moment. It's just not necessarily at the aggregate index level that's nice and easy for you. You can go and pay 2 basis points and get the job done. Yep.
Well, let's get a little bit more specific. I guess what I was referencing then was some of the big names that have been leading the charge. US tech, I'm going to put Bitcoin or digital currencies in there, and even the Australians. I guess the question is, should investors be embracing this momentum? Should they be fearful of it? How do they deal with this part of the market that's capturing so much attention?
Yeah, I think, again, if you want to talk about Aussie banks, kind of more in my wheelhouse, I'd I'd defer to someone who's a specialist in video to talk to you about that. My gut feel for it is I think on this pullback, those things look okay.
Yep.
But certainly, for the Aussie market, I don't think you're going to outperform the ASX buying CPA on 25 times earnings. I don't think you're going to outperform buying a stock like Pro Medicus on 200 times earnings. That's just my view. I might be wrong, but certainly from my perspective, that they're numbers where if I own those stocks, I'd be happy to take profits.
Yep.
And certainly I can point to other stocks across the market that are trading on much more reasonable valuations that are offering, from my perspective, more attractive fundamentals.
Luke, the Aussie dollar has had a big fall, circa 10%. It is obviously a consideration for investment portfolios. As an advisor, what are some of the practical tips you can share with investors when it comes to thinking about the role of currency and investing?
Yeah, we think trying to forecast currency is a bit of a fool's errand, and haven't really found anyone who can do it well, repeatedly.
I would say it's the hardest thing to predict. Currencies.
Yeah.
It almost always goes the opposite way people expect.
And I think there are some good rules of thumb around there that can give you maybe what I'd call an inkling towards what's going to happen. A nice sort of thing I learned at uni is, interest rate parity. You could always use two, relative bond yields to determine, okay, is money going to be flowing to that currency or probably away from that currency relative to the major pairs? So, a little ratio chart of a 10-year bond or a 5-year bond between two countries will give you a pretty good proxy for, where the currency is going to go.
Yep.
That being said, we don't rely on that sort of thing. Again, it's kind of one of those inputs that, it's good to know, but can you really make a decision on the back of it or do anything about it? Probably not. Our approach to hedging and managing currency is that not all the products that we want to invest in from a global perspective offer a hedged alternative. So when they are available, we often will take them up for the simple fact is that, we want to sort of be halfway, a leg on either side of the fence, for lack of a better word. So we'll have some products that are hedged, some that aren't. Relative to the benchmark in our global strategy, we are much more unhedged, but that just happens to be, because of the products we want to use at the moment. And our decisions are always going to be first and foremost, do we want to invest with this manager? Does this product particularly fit with the rest of the products that are in our portfolio? And, we're more focused on the things that are in our control rather than worrying too much about currency. Sometimes it's going to burn you and other times it's not. It's going to work in your favour. That's just investing. Anyone who says investing is on a little bit of luck hasn't done it before.
Yep. I guess the thrust of my question is, after such a big move, we've seen the Aussie dollar, often trades around that 73 cents to the US dollar. It's quite a long way from that. It's been further in the past, down, sort of turn of the century, around that 49 cent mark. But I guess, does it create an opportunity for investors when it seems to move so far, or does it remain a secondary consideration for
It's
you?
always going to be a secondary consideration for us. I think trying to trade that, as I said, is difficult. You might buy it at 63 and think that's the best deal, and it might go to 55. And it's probably just as likely to go back to 68. So, I'm not sure. I think there are people out there trying to sort of strategize around these things. I just don't really see it as a sustainable source of, outperformance or strong returns. And yeah, sometimes it's going to work for you, sometimes it's going to work against you. I think the AUD is not a bad bet at the moment, on a sort of punt basis. But I wouldn't be getting too carried away with trying to trade that.
What about specific stocks that might benefit from, that interest rate differential, that might potentially, sell goods in US dollars and bring that currency back to Australia? Particularly since the move has sort of happened between reporting periods, and you talked about the gold stocks earlier. Are there some specific examples where you think there could be a tailwind from that weak Aussie dollar?
Yeah, obviously, I think with macro and stuff like the currency, we kind of have just a saying like, play the balls as they're bowled. Don't try and be a forecaster. Don't try and be a hero. Just play it as a bold and try and find some good expressions and some good niches to make money out of whatever's happening at the moment. So, yeah, definitely. We're an export economy, so anything that's a commodity exporting, BHP, Rio, we think that's all supportive. Lower dollars, all supportive for them. Whether it's a sort of an international success story like a James Hardie, a Breville, an ARB, all good businesses. All the gold miners, same sort of story there. I think the real opportunity here, though, with a lower AUD is the M&A story. And I think that's going to be the story this year. It's not going to be so much about, BHP's making an extra, X dollars a tonne in AUD equivalent. I think it's more about the fact that some of these big global international names, and we're already starting to see it in the smaller end of the market, are going to start looking at some of the things in Australia that we do really well here and go, hey, we can get a bite of that for a 20% discount. I think that's the story this year.
Yep. Yeah, no, we've heard a lot about M&A activity starting to ramp up, and I guess for an offshore, particularly US buyer, that move makes it a little easier to get it done.
Yeah, and even some of the emerging markets, I think, can sort of benefit from that. And Australia's kind of the developed way to play emerging markets in a lot of ways.
Yep.
So I think that as we talked about, where the money's moving and the rotation of money, I think I'm not the only person in the world who thinks US equities are expensive, and now's not a bad time to trim. And that money doesn't go to cash.
Yep.
It goes to other markets where there's better value opportunities out there.
You mentioned there's been some examples of some M&A activities. Is there something specific to talk to there?
I'm just thinking about that drop suite thing from this week, sort of top of mind. But I think, we've kind of identified, and we've written about it on Livewire, about sort of our M&A thesis for this year around the resources sector, and even into some of the Aussie listed tech names. I mean, I could see a Pointsbet getting a takeover bid this year. They've got a lot of sort of global potential suitors.
Yeah.
And their Australian gambling licence is significantly valuable, and they've got an installed customer base here. So I think there's, plenty of names out there to get into. Okay,
well, let's change gears. You've had your advisor hat on, but as I mentioned in the introduction, you recently celebrated the 1 year anniversary of your small cap fund. We've also seen small caps starting to gather a bit of momentum. They did spend a lot of time on the sidelines. What are some of the higher conviction opportunities you're seeing in small caps at the moment in the Australian market?
Sure. I think for us, it comes back to kind of stuff we've written about and expressed on Livewire before, not so much in the terms of the names, but in the kind of companies we want to own. We like those underappreciated growth opportunities. We think as growth's decelerating around the world and inflation's sort of coming down, by and large, growth becomes more scarce. So if you're a business that can grow in a lower growth environment, you're worth more. So whether that's something like a Catapult, or something that reports really well every February is XRF Scientific, really stable sort of growing business over in WA.
Can you tell me a bit about what it does for our viewers?
So XRF essentially produce products that go into making lab samples for drill cores. So if you want to test what minerals are in the thing, you need to use some of these different chemicals that they produce, and it's kind of a razor blades model, where you sell a machine up front, but then most of your margin comes from selling the ongoing consumables.
Yep.
Really well managed business, kind of integral to what an ALS or an SGS type lab would need.
But a bit cyclical, is it?
People think it's a bit cyclical. It's probably a lot less cyclical than people realise. And I think at this point in the cycle, particularly for the work that they do, I think you're getting it at sort of cyclical lows of earnings. And it's been a really reliable earnings growing business every year. So, like that going into February, and certainly I think a business people need to pay more attention to.
Yep. What are you avoiding in small caps? What won't we find in the fund?
You won't find those really expensive, everybody loves them, every fund manager owns it. I don't own Pinnacle, it's a great business, but I think you can get GQG on 5 times, 6 times cheaper valuation that does essentially the same thing with the same drivers, and I'd argue even better products. So, we don't own that. We don't own Pro Medicus. It's these sort of businesses, I think, whilst they're going great and everything's roses and sunshine, they'll keep going up. But as we saw with, say, Ordinate in February last year, when everybody loved that on 100 times earnings, we had it written up in Livewire saying we think it's too expensive and you should sell it. And within 4 weeks, it had an earnings downgrade and got absolutely smoked, and it's down 50% since, and it's still expensive in our view. So I think, in this business, you've got to be brave enough to be wrong until you're right. And everyone's going to call you a moron until they call you a hero. So that's just the nature of what we do.
Yep.
And why it's important to, I suppose, stick to your convictions, stick to your process, because otherwise, if you're just sort of flipping with the breeze, trying to find the latest, hot momentum opportunity, you can get caught doing things that you later can't explain.
Yeah. You've mentioned there's a few of the names that you've shared via your articles on Livewire. But I thought for this one, maybe you could talk us through the thesis on a recent edition that you've uncovered. And, you often talk about how you take a different view. You've talked about it there about being really willing to, be in an out of favour name or be viewed as being not so much contrarian, but...
Yeah, we're not very contrarian, I don't think, in a lot of the things we say. I just think we just take we just don't believe the hype often. We're a bit cynical, and I think you need to be.
So bring it to life with an example for us.
All right, so it's really new in the portfolio. We only owned it for a couple of months, and that's Euroz Hartleys, so the broker out of Perth.
Yeah.
And there's no broker analyst coverage on this stock at all. In fact, I don't think there will be because everyone's a competitor and no one wants to cover their competitors in this market. It's kind of been discarded by the kind of average fund manager out there as, too cyclical. It's just a WA mining name. If there's lots of capital activity, they're making a heap of money. If they're not, it's a dead business with nothing to talk about. It's got $78 million of unrestricted cash. It's $140 million market cap. And they have a $22 million a year recurring revenue financial planning business. Now, I happen to be in that financial planning business, and I can
full
tell
disclosure.
Yeah, full disclosure, and so I can tell you that those kind of books trade for 3 times sales.
Right.
So, okay, that's worth $66 million. They've got $78 million back in cash. You don't have to be a rocket scientist, right? So, I think for us, that's a perfect example of buying something on a margin of safety. I'm buying a good business that'll pay me, 5% or whatever in dividends. It's not going anywhere. It's essentially a duopoly over there. You've got Canaccord and them doing all the deals, and then Daylight's a tier 3 and 4 broker who are running around in WA trying to make a quid. It's a good, it's been there for a long time. It's well established in the community. From my perspective, you get all the blue sky upside if the capital markets do come back for them and the resources industry does, start coming back, raising money, doing an M&A, which happens to be our view anyway, in which case, the stock could be $1.52.
Yeah.
You're picking it up today for under $1. So from our perspective, that's a really unique, novel, I don't think there's no other fund on the register as far as I'm aware. So,
do you ever get worried when you find ideas where it stacks up so well, but in the small cap part of the market, you don't know who the next buyer is going to be, so you lack that price discovery?
Stuff that's illiquid, potentially. I think from my perspective, I always want to buy something where my bailout position is cash. So you won't find Seneca owning a whole lot of stuff where I need to find the greater fool to flip this to at a higher valuation.
Yeah.
I'm not saying that we don't do it, but it's a relatively small part of what we do. I think.
So that cash backing is an important part.
Well, even just in cash flow. Do you know what I mean? Like
Dividends,
money talks, bullshit walks. I probably don't know if I can swear on this podcast, but and I think that from my perspective, it's a very easy way for us to ensure that Benny and I sleep pretty well at night when we're sniffing around the bottom end of the market.
Alrighty, very good. Now we're going to get into our 3 regular questions in just a moment, but reporting season's right on our doorstep. What are 3 stocks you think can deliver a solid result and potentially give investors a little surprise in February?
I sort of mentioned the commodities.
XRF?
Yeah, commodities picks and shovels. So XRF. We think also, and we own Index as well. So we think, both of those have got some green shoots appearing. And we've seen some nice activity from some peers in comparable businesses. So I think the market's kind of missing kind of both of those. I've got a really Western Australian flavour. I'm being quite parochial today, but AFG Group, Australian Finance Group, Australia's largest mortgage aggregator.
Yep.
If you think the banks are going to win, that's going to win a lot bigger from its current valuation if you think the banks are going to do what they're going to do and make an incremental whatever in NIM margin. So we think that can report well. And I'm doing ResMed for Livewire as well, which we also own and think could report well. I think some of the developments, I suppose, in the GLP-1 market and how that's playing out for ResMed. There's been plenty of fund managers out there talking about it, so you definitely don't need me to rant on about ResMed, but that is a good trade at the moment, I think, and probably will report well.
Okay, well, keep an eye on those through reporting season, and folks, you can follow Luke on Livewire to stay up to date with his views on ResMed when they come out in February.
I'll get you and my mum will be my 2 followers on there. So.
Alrighty, very good. Well, we're going to get into our 3 regular questions, Luke. They're meant to be a bit of fun, bit of a thought experiment, but hopefully push you for a few views. Could you share a story about a big win or a big loss during your career? What happened, and the more detail, the better. And what did you learn?
Yeah, I had a long, hard think when you sent the run sheet through. I had a long, hard think about how I wanted to answer this question, because it's a trick. It's actually a hard question to answer. I think one of the biggest wins I ever had was investing in Zip. So that's been a
first time round or second time round?
First time round. So I was in the back door listing Shell for that business, Rubiana Resources. But again, that was like a sliding doors moment. A lot of what I would call luck involved. I'd kind of committed to invest my money and client money in this other peer-to-peer lending business. It was called Direct Money. It went on to become Wiser, so that business. But that went essentially to zero before like getting recapped and kind of sorted out again and kind of recovered some. But I would have got wiped out, in that kind of time. But I committed, and then Ben Hughes from Perth, who was another broker from Shores at the time when I was at Shores, said, "Oh, mate, you should have a look at this thing we're doing. It's back to listing. You should put your clients in with me, and we're going to do it with the office there." And one of the guys who worked there is John Winters from Superhero. He was best mates with Larry from school, and that's kind of how it came in. And Larry came in, gave me like a 2.5 hour like sort of download, I suppose, on the entire payments ecosystem from his perspective and what he'd been seeing at Flexi Group, working for Macquarie there. And I was just quite impressed with it. I'd been interested in sort of payments, e-commerce and that kind of stuff, hence why I was trying to find stuff to invest in. But yeah, it kind of blew me away. So we pulled that direct money investment, put it in Zip at whatever that valuation was on that backdoor listing, and kind of the rest is history. But yeah, that's definitely been one of the best things I've invested in. And certainly,
the lesson?
For clients, the lesson I suppose is that it's just sliding doors moments sometimes. I could have easily torched my dough, and you could say, you could attribute to yourself and go, well, it's because I was good at assessing Larry's management and I liked the idea that, Zip didn't have really a cost of customer acquisition, whereas a peer-to-peer lender did, and all the other kind of things that I changed my mind. But it's also probably just luck. Like I could have talked myself into saying that the decision to invest in direct money would have been better, and I would have missed it. Yeah. So I think sometimes people are very hard on themselves for things they do or don't do. In hindsight, it's all really easy in hindsight.
Big element of luck to it.
Yeah, there's always a bit of luck involved, and sometimes you can do everything right and you still don't get the outcome that you deserve. And that's just bad luck, unfortunately. And you've got to just keep rolling the dice, because if that dice is loaded enough, if you roll it enough times, eventually you're going to make some money.
Okay, very good. You talk a little bit about market narratives and how narratives are used for marketing and they're convenient, and that as an investor you need to think differently. What do you think investors are getting wrong about markets right now?
Yeah, I mean, it's kind of our core, I suppose, investment philosophy, if you want to. I hate the word investment philosophy, but how we invest is we kind of think about what does everyone else know, what's the story out there, what's the narrative, what do we know? Is that something, and is there a difference between those two things? And if so, what's the best way to exploit that difference and to make money out of that gap between what everyone else thinks and what we think, essentially? So it's kind of how we look at every stock that we invest in. What is everyone getting wrong at the moment? I mean, we own 70 companies across 2 portfolios roughly, James. So we think they're getting something wrong with all 70 of them. But I think talking to a lot of retail investors and talking to people across the market quite regularly now, I think the common things that people get wrong is they're really good at buying, but they're not very good at selling. They lack that kind of ability to say, hey, Pro Medicus at 200 times earnings is expensive and I'm happy to sell it, but because they're so worried about the getting rid of the green number in their portfolio that makes them feel good, or they're so worried that they've missed something and that they're not confident to make the decision. They're so confident to buy it. They're happy to have it, chuck a bit of money at it, but they can't seem to realise that if you've got $100,000 capital gain there, that's $100,000 reinvested in Pro Medicus price today. Yeah. It's because the alternative is cash. So I think that selling discipline, the ability to have to understand that from high valuations your expected return is lower. And that what has happened may not continue to happen in the same way that it's always happened.
I think one of the challenges there, something I encountered myself recently, is you get yourself to that point of selling, but you need to sell and you need to have your next best ideas queued up and ready to go. Because even if you get to that conclusion that it's time for me to move on from this investment, I've done well, you need to have those next ideas. And I think if you have a stable and set portfolio, you're not always, well, personally, I'm not always looking at the next best idea. I don't like to tinker too much and all that sort of stuff. And I think that's actually, along with the challenge of selling itself, that starts that process of what do I replace it with?
But yeah, what you're doing is you're taking something that's emotionally positive for you in this good decision that you've made, and you're like essentially nuking it, and then you're giving yourself work. So it's not a very comfortable thing to do. You're saying, well, not only, so if you don't have a consistent, repeatable investment process, that's the quandary you're going to end up in, is that you don't have another idea. The reality is the reason we think that stock XYZ is expensive is because we've got stock ABC that we think is cheaper and got more expected return. Yeah. So these aren't isolated sort of issues. They're in a portfolio. Everything's always about sitting on both sides of the seesaw and balancing your risk and return. So I don't think that you're alone in that kind of quandary. I think it's quite common, but it's probably the difference between a professional investor and a punter at home.
Okay, well, we've talked about the challenges of selling, but I'm not sure if you told me what you think investors are getting wrong about markets right now.
I think, what do I think investors are getting wrong about markets right now? I think locally, the banks, obviously, I think they're getting wrong. I think they're overvalued. I think large cap, like top 20 in general, is really overvalued at the moment, broadly speaking. They're also, I think the idea that, resources are in a multi-year recession, I think that's not accurate. And particularly Australia has a significant competitive advantage in the way that we dig stuff out of the ground. So I wouldn't bet against that for the long run. I think I've written about it on Livewire. I think people's environmental aversion to Australian thermal coal when the next best alternative produces more emissions is wrong, and we should be, investing more in it. There's not I don't know anyone else who's making that argument. So
it's not a popular one.
No, not a popular one. So, and I consider myself an environmentalist. So like, that's just the data, it's the facts. So yeah, there's plenty of big narratives out there that, I don't really believe in ESG investing either. I think that you need to be, there's too much greenwashing and, there's too much rubbish out there that it makes it all clouded and you end up just paying more in fees. You're better off just saving the fee load, investing, making a heap of money with whoever, and then giving it to your favourite charity. Yeah. So just those kind of ideas, I think, are maybe not consensus.
Yeah. No, clearly. All right, final one, and this one for listeners out there, this is not, we're not suggesting you go and put one stock in a portfolio. This is meant to be an exercise in long-term thinking and hopefully a bit of fun. But Luke, if markets were to shut for 5 years and you could only own shares in one company, what would it be and why?
I think if people couldn't punt on stocks, they'd punt on gambling. So I'd say like a Pointsbet. So
I like the
if
logic
the market's
there, yeah.
shut, then you can't do that.
We saw that during COVID, didn't we?
Yeah, kind of the
reverse.
So I think that if you're talking about like picking a stock for the next 5 years and kind of just owning it passively, I think it's indicative of how people get investing wrong, that question. Yep. So I think the idea that I can give you a name and you can just passively buy it, and for 5 years, and then you'll make a really good return on your investment over 5 years, is kind of like sort of like the Big Short idea. I probably would put it to the Michael Lewis book. The idea that you've got this really well researched and thought out counter consensus idea, this home run. When in reality, I kind of think investing is a lot more like Moneyball, like the other Michael Lewis movie, which is you want to find a portfolio of kind of misfit toys that kind of other people don't really see the value in, or they're not looking at the right way, and you can kind of put those together in a portfolio, and they might not all hit, but in the aggregate you can win. And I think with win rates of the best fund managers around the world in the 50s, the math says that it's only in the aggregate that there is value. And as much as we love talking about stocks and we love talking about our portfolios, and it's great for marketing and people get excited about them, at the end of the day, the value is in the team building. It's not in the name. So I'm probably going to annoy you with this answer, but I think it's kind of relevant.
All right, so you give me Pointsbet, is that what you're
I'll give you a Pointsbet just because it's in the portfolio.
Just for the record.
Just for the record, yeah.
Very good. Well, Luke, it's been a pleasure having you on the Rules of Investing. Thanks so much for coming up to Sydney and stopping by the Livewire office. For all you listeners out there, I hope you enjoyed that discussion. All the links will be in the description on the podcast. And don't forget, if you enjoyed the podcast, give it a review. All helps for us to reach new listeners. So, Luke, thanks very much for coming in.
Absolute honour to be here, James. Thanks very much.